Baupost Group is a $30 billion investment fund that just released their 13F filing. The fund is managed by legendary investor Seth Klarman, who has massively outperformed the market over the past few decades by following in the footsteps of Warren Buffett. And in this past quarter, Seth Klarman, through Baupost Group, invested in a very unique type of stock called a Special Purpose Acquisition Company, or a SPAC, and this particular SPAC is run by another legendary investor, Bill Ackman. So today I'm going to be explaining what a SPAC is and then provide some analysis on Seth Klarman's investment in Bill Ackman's stock, which is called Pershing Square Tontine Holdings. Also, I am going to be covering a lot of these 13F filings where we get to see the portfolios and trades of big successful investors and these huge investment funds. I'm going to be covering a lot of them over the next couple of weeks. So if you want to be up to date with content like that, then make sure you hit that subscribe button and make sure you hit the notification bell so you get notified when I'm posting, and you can expect a bunch more of these videos coming out over the next couple of weeks. Now, before we jump into the investment that Seth Klarman through Baupost Group made in this special purpose acquisition company, I first want to just briefly explain what a 13F filing is for those who are not familiar with this particular filing that big institutional investors need to make on a quarterly basis. So as I just mentioned, these 13F filings are a quarterly filing, so they're made 4 times a year, and they are only made by big institutional investors who have assets under management over $100 million. So we're talking about big funds that are managing a lot of money, and in Seth Klarman's case, we're looking at a fund that is managing $30 billion. And what these filings basically show us is the holdings in the stock market, equity holdings of that fund at the end of the quarter. And this allows us to see a couple of things. The first is, of course, we can see their current stock portfolio, but we can also compare that 13F filing to the previous quarter to see what changes were made and essentially figure out what were the trades that were made by that institutional fund during the past 3 months. Now, you can get these filings directly from the SEC website, although if you've ever been on that website, it is an absolute nightmare. It is not a fun website to try and browse. So there are a number of other websites that take the data from the SEC website and make it a lot easier to understand and a lot easier to read. One of those websites is Whale Wisdom, and I have to give a shout out to Investing with Tom because I didn't know about this website until Investing with Tom, or Invest with Tom, I think it is, shared this with me. So go check out his channel if you're interested. He will also be covering a lot of these 13F filings over the next couple of weeks, I am sure. But Whale Wisdom is a fantastic website for going through and reading what is in the portfolio of these big funds, and then, as I mentioned, what trades have they made, and they also do some estimations in terms of what average price certain fund managers paid for certain stocks and that sort of thing. Now, one important thing to mention when it comes to these 13F filings is it only shows us the stock portfolio part of their assets under management, right? So these big funds, usually they have a number of different assets. They'll have some stocks, they'll have some cash maybe, they'll have some bonds, maybe some commodities and other types of assets, real estate, for example. These 13F filings show us none of those things, only the stock portfolio. So again, using Seth Klarman as an example here, their assets under management is $30 billion, but their stock portfolio is only $9.3 billion. So we can only see the $9.3 billion. We cannot see what the remaining $21 billion is. My guess is that some of it would be cash, considering Seth Klarman has a history of holding on to cash when things are relatively expensive, but it's also likely that he has other types of assets under management as well. Now, in terms of this specific 13F filing by the Baupost Group, which is Seth Klarman's fund, they made a number of different moves throughout the quarter. They sold a little bit of their Facebook and Google positions. They sold a little bit of their biggest position in eBay. But I think the most interesting part of this 13F filing was a new position that was initiated in the Pershing Square Tontine Holdings, which is a special purpose acquisition company. Seth Klarman invested a total of $397 million at an estimated price of $22.70, which makes this position 4.3% of his stock portfolio. And this company is no typical company, okay? Your typical company has products and services, they have some operations, they have a network of employees and suppliers and manufacturers, manufacturers and they're producing something, right? This company has none of that. It does not have a product or service. It does not generate any money. It is called a special purpose acquisition company, or a SPAC for short. And these types of companies have only one purpose. And that purpose is to raise capital to acquire another company. So you are essentially investing in what's called a blank check company, where you're passing your money off to some CEO, someone who is running that company, who is then going to make an acquisition decision. And as an investor, you don't even know what the fund is going to invest in. So you have no idea when you buy this Pershing Square Tontine Holdings, you have no idea what company you will end up owning. These special purpose acquisition companies are typically set up as a trust, so that you're a beneficiary of a certain set of rules in which that company needs to operate. And some of the most common rules are, of course, that the company needs to be acquiring another company. So that's the main purpose of the money that is raised by the company, is to try and acquire another company and give ownership of that company to the shareholders. And the other rule that is usually in place, and is in place in this particular SPAC, is that there is usually a 2-year period in which the CEO of the SPAC can try and make an acquisition. And if they cannot make an acquisition in that 2-year period, then the money is returned to shareholders at the IPO price, which in this case was $20 per share. But if a private company is acquired, the SPAC will then take that private company public, and then essentially the shareholders of the SPAC will become shareholders in this new public company. So it's essentially a different way for you to invest in a private company that has not yet gone public. And it's also a slightly different way for a private company to go public with sort of a certain valuation set already, because they've already sold a certain chunk of their business to these SPAC investors. And because the investors in a SPAC have no idea what company is going to be acquired, you're essentially making a bet on the person who is making the acquisition decision. So you're essentially passing your money off to somebody else to then make a good acquisition decision, to make a good investment decision on your behalf. In this case, the SPAC is run by Bill Ackman, and Bill Ackman has a net worth of $2.1 billion, and he runs Pershing Square Capital Management, which has $11 billion of assets under management. The SPAC raised $4 billion in July, and Ackman is expected to contribute between $1 and $3 billion, which means the SPAC will have between $5 and $7 billion to make an investment. Now, there's a couple of options when a SPAC is created, right? The CEO has an option to try and acquire an entire company. So they could try and acquire an entire company for somewhere between $5 and $7 billion. Or they could just try and acquire a small piece of a business, maybe 30% of a $15 billion business. And Bill Ackman has said that he is looking to do the latter of those two. He's looking for a business that's worth between $10 and $15 billion that he can buy a small piece of. And the reason why he says he's going to try and do that is because whenever you're trying to buy an entire company, the shareholders or the owner of that company wants to squeeze every last dollar out of that acquisition, because they're selling the entire company. Whereas if they're only selling 30% of the company or 20% of the company, they're a little bit more flexible in terms of the price that they're willing to sell that portion of their company, because of course they still own 70 or 80% of the company that they could then sell at a higher price at some point in the future. And of course, because this was such a high profile SPAC, it was the biggest raising in history in terms of these special purpose acquisition companies, there has been a lot of speculation and a lot of coverage in terms of what company is going to be acquired. And the first company that everyone thought was going to be acquired was Airbnb. So everyone thought that Pershing Square was going to be able to buy a little piece of Airbnb and then take that company public. However, Airbnb rejected the offer from Bill Ackman, and Airbnb is still expected to by itself IPO on the public markets in December. So Airbnb is looking like it's not going to be an acquisition target. The next target that people thought was going to happen was Stripe, which is a payment processing service for online. I use it for my business. It's a fantastic service. Again, there was talks with Stripe and those seem to have fallen through. And there's one other company, which is Bloomberg, which I'm sure everyone is aware of, which is apparently also in talks with Bill Ackman. And the interesting thing about Seth Klarman getting in on this deal now is that Seth and Bill Ackman have worked together and communicated on deals in the past. So it's entirely possible that Seth Klarman knows something about this deal, knows that a deal is coming in the near future, and as a result is now investing money into that SPAC. But it's also possible that he just wanted to get in on the SPAC and he actually has no idea if or when an acquisition will come. Because remember, this happened during the third quarter of this year, which is between July and September. And that was the period in which this SPAC IPO'd. So it's also entirely possible that he just got in on the ground floor of this SPAC. We really don't know. There's just a lot of speculation around why Seth Klarman is getting involved in this. And then also a ton of speculation, of course, around what company will end up being acquired, if any company, right? Because at the end of the day, they might not make an acquisition. They could just end up giving everyone's money back. So now I just want to briefly give my thoughts on this investment by Seth Klarman, and then of course my general thoughts on special purpose acquisition companies and this one in particular. Personally, I'm probably not going to be someone who would invest in a SPAC simply because I don't know what company is going to be acquired. And beyond that, I don't know what price it's going to be acquired at. And those are two decisions that I like to make myself as an investor. I like to invest in businesses that I understand, study them deeply, and then make a projection about where I think they can go in the future so that I can make and reach my own investment decisions. And that's not something you can do through a SPAC. You're basically passing off all of that responsibility to the fund manager, and in this case, you're passing it off to Bill Ackman. I think the only time that I would invest in a SPAC is if I was really, really behind the investor that was running it. And in this case, I'm not completely behind. I don't religiously follow Bill Ackman. I think he's obviously a fantastic investor and he's made some great investments in the past, but he's also done some really awful and unethical investments. And if you haven't seen the Dirty Money episode on Valiant Pharmaceuticals, go watch that episode. It's on Netflix. That is just a horrible situation that I can't even believe someone like Bill Ackman would get involved in. Or maybe I could, but either way, he's made some terrible decisions in the past, and he's just not someone that I align with. So as a result, I'm not so super excited to jump out and invest in this SPAC. I mean, I think the only two people that I would follow into a SPAC is if either Charlie Munger or Warren Buffett were to run one, and I think that's probably very unlikely at this point. The other thing to mention is that you can invest in this SPAC now. Of course, you can just buy the stock on the public markets, but it would have made a lot more sense to invest in it at the time of IPO. And the main reason why is when it IPO'd, you were not just getting one share of ownership, you were also getting 1/3 of a warrant attached to each of those shares. In the case of Ackman's SPAC, investors got a share as well as 1/3 of a warrant with a strike price of $20, which essentially meant that if you took part in the initial public offering, not only did you get to buy one share of the SPAC for $20, you also got a contract which gives you the right, but not the obligation, to buy another one for every 3 shares that you held at $20. So essentially at IPO, you got an extra option to add more shares at a lower price than the current market price, which meant that it was a much better deal at the time of the IPO. That is no longer the case. In September, the share and the warrants split. So they were tied together as one financial instrument. Now they are split. You can invest in either one of them separately on the markets, which means that you're not getting a combination of both. And of course, if all of this sounds extremely confusing and you have no idea what I'm talking about, then don't worry, because a lot of this is extremely confusing for me as well. And anything that is really technical, I just tend to stay away from. I like very traditional businesses that are easy to understand. They have a strong financial position, no debt, lots of cash. They have a really great, simple, but powerful product that attracts customers or clients back to that business consistently, so that I can easily and reasonably project what I can get out of that business in the future. That's where I am very confident investing. And these kinds of special instruments that you can invest in, I tend to stay away from. So I hope you guys enjoyed this one. And as I mentioned earlier in the video, I will be covering some more 13F filings throughout this week. So if you want to stay up to date, the best thing you can do is hit that subscribe button and hit the notification bell so you get notified the next time that I release one. You should expect one in a couple of days and then another one a couple of days after that. So that's what you can look forward to on this channel in the next couple of weeks. And of course, if you did enjoy it, make sure you leave a like and let me know your thoughts down in the comment section below. But I hope you guys have a great day, and I'll see you in the next video.